More of a mixed end of day for U.S. markets. My next guest advises investors not to become too negative despite a pullback. Let's go to Youngyu Ma, Chief Investment Strategist at PNC Asset Management Group. Thanks for joining us today.
Thanks. Great to be here.
What do you see as the driving one or two forces for the U.S. markets this year?
Well, we do think it's a favorable setup. We think probably the biggest driver is productivity. We think that the productivity gains that companies are seeing is going to hit the bottom line pretty squarely this year, and that's going to just help to support earnings growth and the overall profitability. That's probably number one. Of course, there are technology underpinnings. AI underpins that as well. But then you have added fiscal support. You have tax cuts that will be kicking into effect this year. You also have monetary policy, which should also lean dovish this year. And so if we think about the big factors, those big factors are still in place for a favorable setup for 2026.
Okay, so let's talk about AI a little bit more. Are the valuations still of a concern to you, or are you concerned about some of them versus others?
Well, I think there are elements and areas where valuations have probably gotten ahead of themselves, but there are probably also areas where we're going to see new developments this year and some exciting gains or new areas that can outperform. So I think that's a mixed bag. I do think it's going to overall hold up, but probably the winners from last year aren't going to be the exact same winners for this year. Probably some of the users of the technology are going to be more of the winners from this year, or at least going to be into that group of those that are winners and not just the infrastructure build out. I think that infrastructure build out play, it'll still continue, but it's not going to be as strong as it once was.
So it might be, for example, financials who are gaining in their back room by having to hire less and perhaps have AI pick up some of those jobs, banks, those kinds of things.
Well, we do think financials are poised to do well. For that reason, we actually saw an announcement today that some of the advisory firms that financial companies use might not be as necessary, and that's another way to cut costs for financials. But we also have an expectation in the U.S. of a steepening yield curve. So that as well is something that benefits financials. Modest, not excessively high valuations in financials, especially if you look down at the mid-cap space. Relative to their history, probably pretty neutral valuation. So I think that's a good story there as well.
What are the other sectors you see that could sort of benefit from the broadening out that's expected this year?
I think you have to actually probably look down into subsectors and what trades at a relatively modest valuation that still has good growth prospects. Probably the airlines fit that bill, trading at modest valuations. You've seen some consolidation or a little bit of washout among some of the smaller players in the airline space. I think that's beneficial, along with healthy demand with a stable economy. Those two things go together, and people being willing to pay up for some of the first class and business class seats. That's probably an area that'll do well. But I think there are areas in healthcare that'll probably do well this year also. I think one thing we'll see as the year progresses is some more populist policies as we get closer to those midterm elections in the U.S., and that'll probably help the healthcare space.
Yeah, typically, how does a midterm year shape up for the markets? We know this president is very focused on trying to sort of keep money in the pockets of Americans. What do you think it means for the markets, it being a midterm year?
Well, what usually happens is that the midterm years are relatively stable for the first 6 months, and in the 3 months running up to the midterm election, there tends to be somewhat of a pullback or more volatility. And then after the elections, you get a bounce back. That's the typical pattern. Now, that's not 100% that's how it plays out, but some years it does tend to play out that way. I'm not sure it'll play out that way this year because I do think President Trump is focused on trying to prevent some of the midterm losses that are being projected now for the Republican side. And one way to do that is to focus on affordability, to support the middle class, and to come out with policies or proposals that would do that. I think that on average is going to be stimulative. And so going into the election, I'm not quite sure we'll see that same degree of pullback or caution. And even if the Democrats do have significant gains in midterm elections, that probably means more spending next year in terms of some of the compromises that take place, say, in the healthcare space, for example.
Are you, or I know you are, keeping your eye on sort of Chinese innovation, Chinese technology as well? Are there investing opportunities you see there?
Broad-based, I would say certainly there's a lot of innovation that's coming out of China and some of their technology companies. Really, if you sort of follow the headlines, there's very exciting things coming out in the robotics field, of course, EVs. Their AI models are quickly catching up to US models. I think it's an area where there's a lot of strength there, and it pays to lean into that in a broad way. Not necessarily to try to pick the individual winners, but to try to look for a diversified way to get exposure to Chinese technology. There are really two big bastions in the world of strength in technology, and that's the US and China. It doesn't make a lot of sense to only be exposed to one of those two.
All right, Young-Yu Ma, got to leave it there, sir, but thank you for joining us today. Appreciate your time. Young-Yu Ma is Chief Investment Strategist, PNC Asset Management Group.